Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia and still down close to about 200 points in the Nifty. The Nifty's at the 24,600. Expected to be a muted start. Caution prevailing across the Asian markets too. And so far, there hasn't been a recovery.
Yeah, repercussions felt on
ripple effect.
Ripple effect, and it's showing up on a lot of these sectors as well, right? You see it on IT, you see it on a lot of these export-oriented names as well. But again, 24,600 is the level that the Nifty is fighting to hold on to currently, even as IT has recovered a bit from the lows of the day. Some very choppy moves seen in the metal names, but still a 200-point cut on the index. Currently seeing a bit of a status quo as of now, not falling, but we are not trying to recover from the lows as well. Of course, there are plenty of stock-specific movers in the broader markets, and they are the ones that are either reacting to earnings or there have been news flows related to them. NTPC Green Energy at one point was up 10%. It's slightly off the highs of the day. Now it's still up 5% and among the top gainers on the Nifty 500. But the one that has sprung up to the highs of the day is Shipping Corporation of India, and that is now up 10% in today's trading session as we speak. So the top gainer there, Shipping Corporation, at the highs of the day. Speaking of shipping corporations, Garden Reach 2 had seen a bit of a surge after it emerged as the lowest bidder for that 25,000 crore project for the Indian Navy. So 4% higher on Garden Reach as well. And it's doing well for itself. A lot of these names, including the likes of Astral, which is an earnings reaction, Solar Industries, that is continuing to build on to those gains that have been seen post the positive management commentary. So that's another gainer. Among the losers, though, today we have BSE. Of course, we just heard from Yash a few minutes ago on the exclusive that he had done on the expiry days, and the decision from SEBI could be out soon. So 5% lower on BSE. Colgate Palmolive is an earnings reaction, so 4% lower on that stock as well. And JK Tyre giving up some of those gains in today's trading session as well. But of course, the big earnings reaction that we were watching out today has been IndusInd Bank, and after opening 5% lower, there has been a significant recovery in the stock, seeing some choppy moves today. At one point was up almost 3%, and this is despite a quarter that was weighed down by accounting issues, the MFI stress, and a lot of other issues as well. Abhishek is now joining in to tell us what brokerages are making of these numbers. Abhishek.
It's the highest percentage earnings cut that I've seen in the banking sector post the numbers of a lender in Q4 FY25. So brokerages have cut earning estimates ranging from 35% to 40%. Motilal Oswal has cut by 45% over the next 2 years for IndusInd Bank. Loan growth to be in single digit in FY26, largely brokerages say that, and about 10% in FY27. Now, it's difficult for the bank to reach an ROA of 1% is what the brokerages do say. The path is long drawn. ROE to be below the 10% level, around 6 to 8% over the next two fiscals. This event to monitor will be the new CEO at the helm, whose name, the bank will submit to RBI by the end of June, that is 30th June 2025. Now, largely brokerages have, cut down the target price. Some of them are downgraded, like IFL Capital to reduce from add. HSBC has also downgraded to reduce. Target price has been cut to as low as 600 per share, while Macquarie has a target price which is the highest on street at 1,210 per share. Back to you.
Thank you. And it's over to Ritu now, who joins in with the key conference call highlights from IndusInd Bank. Ritu.
Well, after posting its biggest ever quarterly loss driven by multiple accounting lapses that are now being labelled as fraud, IndusInd Bank is promising a full clean-up. In an unusual move, we had Sunil Mehta, who is the bank's part-time non-executive chairman, personally addressing analysts on the earnings call, calling the developments since March unfortunate and painful. Now, he acknowledged that the board was not informed of these discrepancies at the time of approving results earlier, but assured stakeholders that now the bank is taking comprehensive corrective action. He sought to allay concerns, saying auditors have now conducted deep dive reviews with expanded sample sizes to adequately and fairly account for any past lapses in the fourth quarter earnings, and that the board now suspects a fraud against the bank that involves certain employees and is pursuing legal action, including reporting to investigative agencies and regulatory authorities. He also reiterated that the board's approach is to start FY26 on a clean slate, with all known financial impacts already absorbed in the FY25 numbers. The chairman also disclosed that RBI has advised the bank to submit proposals for the appointment of a new CEO for its approval by the end of June, and that the board is in advanced stages of the selection process and is hopeful of submitting these recommendations ahead of the deadline. So now, while there may be questions on the auditors and the board's own accountability and how quickly a new CEO is appointed and is able to steady the ship, the biggest question for now is whether the worst is behind. And to that, all that the management has to say is that the full financial impact of all the known irregularities has been accounted for, and to the best of their understanding, no further issues remain.
Indeed, Ritu, thanks a lot for that. And that's IndusInd Bank for you. Earnings cuts, target cuts. The stock currently trading around 0.4% lower, having given up most of those gains that it saw in early trading. But the other mover in today's session is VRL Logistics, and that is, of course, on the back of its earnings, 10.5% higher on that stock. Mangalam is here to tell us what exactly happened during the quarter, Mangalam.
Two things happened in the quarter. The company got rid of low-margin businesses, and as a result of which it improved its realizations. And secondly, they increased their cost-saving initiative. So if you look at it, the revenues were up just 5.6%. No big great shakes out there, but the EBITDA jumped 77% year-on-year. Margins improved by 1,000 basis points. 13.7% turned into 23.1%. And we have the net profit, which surged from 21 crores all the way up to 74 crores. So near 250% jump out there too. This continuation of low-margin businesses impacted volume growth, so that's reflected in an 11% volume growth that we've seen, volume degrowth that we've seen. But realizations improved by 18% because they've discontinued those businesses that didn't make them money. And at the same time, they've also increased their cost-saving initiatives by buying in bulk fuel. So earlier that accounted for 31% of their total purchase, and now it's accounting for 41%, as a result of which their diesel procurement prices came down from 87 rupees per litre to about 84 rupees per litre. Going forward, they are looking at prioritizing volume growth. So maybe the volume dip that happened right now will recover going forward too, along with cost initiatives. The street likes that. The stock up 10%.
Thank you very much for that. I think there is a dividend as well that the company has announced of 10 rupees. Margins are 23%, highest that we've seen in the last many quarters. And also VRL Logistics, as the stock hasn't done too much. In the last 3 years, the stock price is only up 7%, which basically is today's up move. Strip that out, 3 years, the stock has pretty much given no return. We will get into a break. Thank you, Mangalam, for that. On the other side, we'll discuss commodities. Manisha Gupta joins in.
Welcome back. Still near the 24,600 mark on the index, but we're shifting focus now to the commodity space. Manisha Gupta is joining in, and today we put the spotlight on silver, Manisha.
Well, yes, that is because we are not too far away from that lakh rupees a kg mark yet again for the Indian markets here. In the global markets as well, this week has been quite positive. We are up by more than 3.5%. Silver is trading at a 3-week highs as well. And for the Indian markets, as I said, we are going back towards that all-time highs that the silver prices did touch in the month of Feb there. Well, a few factors which clearly are supportive for silver buying currently. One is the decline in the US dollar index. Well, that has been supportive for most tangible commodities. The second is the safe haven buying. We've seen that come back in case of gold, and silver seems to be going higher because of that. And then because silver is part industrial metal, most of these industrial metals have been doing quite well in this week, and that in turn has been supportive as well. Well, just to tell you that nearly 55 to 60% of all silver usage in the global markets comes in from industrial fabrication, industrial demand, that is. And the additional supportive factor is that 2025 is going to be a 5th straight year that you're looking at global silver markets in a supply deficit. Last year, it was a supply deficit of around nearly 2 billion ounces, and this year as well we are looking at a very strong deficit. Those are the numbers that tell you that after a record silver industrial demand in last year, this year as well, a 700 million ounces of an industrial demand is what the street is anticipating. So everywhere that you look, there's very strong support coming in for the silver prices. And the kind of numbers that we've seen come in from EU and China also suggest that the solar industry seems to be needing more and more silver as we go forward from here.
Thank you very much for that. Now moving on to Bansal Wire. Reported a decent set of numbers in Q4. The top line and the bottom line went up by nearly 35%. Pranav Bansal, Managing Director and CEO of the company, is now with us on the show. Pranav, hi, morning. This is Reema here. Good quarter. Now as we look ahead, what can you guide for FY26 in terms of volume, since there is incremental capacity which comes on stream? And what was the volume number and the growth in FY25?
Sure. Hi. So 25 has been a good year for us. We closed at about 3.5 lakh tons in volume, which we started off the year with 2.5. So that was a good jump that we were able to see. Of course, part of it was due to consolidation. Looking ahead, even in FY26, we see some good volumes coming in. Now that we have about 5.6 lakh tons of installed capacity with us, we are looking to ramp that up very soon and very quickly. So we are looking at about 20-30% jump in volume.
Looking at 20 to 30% jump in your volumes. Pranav, good morning. Thank you for joining in. I'd like to ask you about the Dadri facility. You had earlier mentioned that you had mentioned in the previous quarter that you see around 20 to 25% utilizations there. What are the current utilization levels, and do you expect them to ramp up in the new financial year?
So in fact, we closed at about 40% utilization for the last month of the year. So with that, we would try to utilize that to the maximum level possible this year. That's how we are looking at a 20 to 30% volume jump. And now with that capacity, we had 5.6 lakh tons in total, which will also jump by about 1.2 lakh tons in the next 2 quarters as well.
So your installed capacity will now, say by the end of next fiscal year, would stand at 6.8 lakh tons. Is that correct?
Absolutely. Absolutely.
Okay.
This is in lieu of the demand that we are looking at, or we're seeing from our customers in all our entities.
Okay, but your volumes, you're saying, will only go up, say, by 30% on a base of 3.5 lakhs. So 4.5 lakh tons would be the volumes in terms of the sales?
That's the least that we're looking at. Although this year will be a year where we would want to ramp up our volumes even higher.
So what would be the realistic volume growth? Because you're giving a guidance of 20 to 30%, but you're saying it should be even more than 30%.
I mean, that's the target, but I think a safe estimate should be about 20-30%, in which we should be able to very easily.
Pranav, are you witnessing a slowdown in any of your segments? As far as your business mix is concerned, most of your business is towards the auto segment, then you go into infrastructure, engineering, durables, and miscellaneous as well. Do you expect this mix to remain how it is in this financial year as well? And in the sectors mentioned, are you seeing any slowdown so far? What is the kind of on-ground scenario you're witnessing currently?
So our main strategy has been to diversify as much as we can in different end users, and that has worked for us throughout the years. This year should also not be very different. We are looking at a similar product mix even this year. This in turn with a lot of new products that we have added. I think automotive will be the largest end user as was last year. And on the demand side also, we see good demand coming from our customers. We are also increasing our market share in those customers while adding new products, new offerings for those customers.
But Pranav, now that your Dadri facility has now ramped up, as you mentioned, you ended the year at around 40 to 45%. Do you see an improvement in your EBITDA per ton levels from the current levels? If you could mention, what are the current levels and what are you anticipating the growth to in the new year?
So we are now implementing a 2-year strategy in which FY26 will be a year where we want to grab a higher market share, even if we have to sacrifice our EBITDA a little bit, so that by FY27 we can come back to the same level of EBITDA with a higher base. And plus, with that, we will also be established in our backward integration project by FY27. So that will also give a push in our EBITDA going forward. But for FY26, because of the product mix and because of a higher volume base that we are targeting, we feel that the EBITDA might go down by 10% in per ton basis. But of course, in absolute numbers, it will definitely go up because of the 20-30% increase in volumes.
So EBITDA per ton will go down by 10% in FY26 is what you're trying to say as you try to gain market share.
Absolutely.
So
And
what is the current?
This is also a mix of product mix. It also differs in the product mix.
What is your current market share, Pranav? What are you targeting to get to?
So currently, I think we would be at about 8%, 9% kind of a market share, and the industry grows at about 7% every year, whereas we've been growing at 20-25%. So every year we gain some market share.
What about exports? What's the contribution of exports to your overall revenue? Say FY25, what did it grow at?
So last year we closed at about 10% of our revenues in export, and I think that is our target even for this year. We are a company that is focused on the domestic market, and that is where we see a lot of good demand coming from. Of course, export should also grow at a reasonable pace, but the percentage of export in our total revenue should be similar.
What about your capex plans, Pranav? You've highlighted that there is a 600 crore investment in Sanand that you're making for a 1.8 lakh ton steel plant and a stainless steel wire facility as well. You are currently debt free. So how are you funding these? Is all of the 600 crore being funded via internal accruals?
So majority of it will be absolutely funded through internal accruals. We've done an EBITDA of about 270 to 80 crores last year, and that should only increase this year and the year going ahead. So in the next 2 years, we should have enough internal accruals to fund this with some mix of debt.
What will be the asset turn?
Asset turn, I do not have those numbers right now.
All right, Pranav, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Bansal Wire there on the road ahead for the company. Take a short break. A quick chart check on the other side as the Nifty is now slumped to the lowest point of the day. Sudeep Shah of SBI Securities joins in with some trading ideas as well. Stay tuned.
चल रहा है.
हाँ सर वैसे ही है. So no
change in the current thing, but क्या changes further आएंगी वो अभी आप थोड़ी दिनों के में आप.
So sometime this month.
Yes.
So that's very soon, sir. It's only 22nd. So it's already 22nd, so that'll be very soon, I think.
It should be soon then.
Thank you, sir. Thank you.
Sir, update on the panel.
IndusInd Bank, sir, the board yesterday said that it has submitted its report to the government. So any step that SEBI is taking on that and regulatory agencies?
No, I think the RBI is looking into that. Whatever the SEBI has to do in relation to whatever SEBI's remit is, SEBI is doing.
Sir, can I also ask you on the NSE IPO? It's been stuck with SEBI for a very long time.
Yeah.
What is the update on that?
Is there any progress in the process?
Which?
NSE IPO.
NSE IPO, I think all I can say is that if all the outstanding issues will be resolved and we will move forward.
So by when? Is there any timeline on it?
Can't give you the timeline, but I think we should soon be doing it.
So have you received any assurances from the NSE side on some of the outstanding
NSE and
issues?
SEBI, they are talking, and I think they're resolving the issues, and I'm very hopeful that it will be cleared and we'll move forward.
Sir,
There's one issue is about the crypto regulation now. The crypto is at 110. And there is a demand that there should be a proper regulation in India. But as of now, as a regulator, what is your view on this?
No, that is a policy call is to be taken by the government. Crypto as such is not a security at the moment under the SEBI's remit.
So also on the NSCL matter, sir, is there any settlement scheme that's likely for the commodity brokers on the NSCL scam that happened earlier?
NSCL is.
NSCL.
Yes, I think we are working on it. That will be through soon.
And sir, also are we looking into the corporate governance issues of IndusInd Bank after GenSol, that initiative that you've taken?
I replied, whatever
Achha, okay. That RBI is looking into.
It's RBI's remit, so far as a bank is concerned. But to an extent, whatever there could be, if there are any egregious violations by anyone in its capacity, that SEBI is looking into it.
Okay. So just coming back on that expiry date, sir. So just queries coming in that. So as of now, there is no change. Tuesday and Thursday is what it is at the moment. But going forward, waiting for your further directions, that may change. Great, sir.
Thank you, sir.
Thank you, sir. Thank you very much.
See you tomorrow.
Thank you.
Important comments there from the SEBI chairperson Tuhin Kanta Pandey on the NSE IPO, on IndusInd Bank, the expiries as well, the story that Yash just broke a few minutes ago. So important commentary coming in there, and he mentioned that they'll be issuing directions on the expiry dates this month after comments received on the consultation paper. So the decision is likely to be soon. And on the NSE IPO, of course, he did mention that all the outstanding issues will be resolved. Of course, he did not share a timeline as to when does that happen, but he said that he is optimistic that this will move forward soon enough. So important commentary coming in there from the SEBI chairperson. But time to talk more on the markets. Then Varun Locha from HDFC Securities is now joining in. Varun, good morning. Thank you for joining in. IndusInd Bank, of course, can't not talk about it. After the loss that it was reported, the commentary that you heard from the management yesterday, do you believe that the worst is now done, or there are more questions than answers here?
Yeah, hi, good morning. So IndusInd, it's actually there are still a lot of moving parts. We are not able to get an exact handle on the underlying numbers. But our view on the stock, we have a reduced rating. And we believe even if this is, probably all the skeletons are out, and if this is the worst number, even then we believe the road to recovery will be a prolonged one because a lot of things have to fall in place. In terms of, even the liability franchise is weakening a little. The investor confidence is really shaken up. So I think the path of ROA improvement will not be a very smooth one. And therefore, we believe it's better to avoid it at the time being. And, we have other stocks in the sector which are looking more attractive from a 12 to 18 month point of view. So that's our view on IndusInd.
Varun, do you have a view on BSE? Because sources, I don't know if you've caught the story that Yash has been putting out, but sources have said that SEBI's circular on index expiry days for exchanges may come soon. And NSE has likely applied for Tuesday as its expiry, which is basically BSE's date. So for NSE, it shifts from Thursday to Tuesday, if approved. So if that happens, what could be the potential impact on BSE and how would this play out?
See, again, if it were to happen, there will definitely be an impact on BSE volumes because the pace at which they have been gaining market share in the derivatives market was really strong. We currently have an ad rating, but our target price is not materially higher from the current price given how sharp the run-up has been on the stock. Our thesis has been on medium-term market share gain story in derivatives, which has played out to a large extent, but we believe it is still, there's some more room for market share gains over next 12 months. But if this were to come, this will definitely impact, in terms of earnings because the pace of market share gain, accelerated after the change to 2 expiries per week.
Right.
And Tuesday would always get a better volume market share. So. But
right.
We won't be able to comment on specifics till it comes out, and gets.
Varun, while we are on this subject, let's just go across to my colleague Shivani, who is in conversation with Ashish Kumar Chauhan of the NSE.
Have their own strategies. Other independent blocks like China or India will have their own strategies, and so it remains to be seen finally how it settles down with the US, but also across ASEAN and many other blocks. And so it is just what I call a beginning of a change where India has not been a very large part over the last 30-40 years of the trade portion of it, that is the manufactured goods trade. because we have been more in services, but we are getting an opportunity to realign our manufacturing to ensure that when the world is trying to move away from China, India has a legitimate claim, and of course with its skilled workforce and low labor cost, we should be able to make a good dent in the manufactured exports also.
Okay. So FII outflows was also some of the concerns, was one of the concerns in the past few months for the Indian market. Has that stabilized, and what do you think in terms of after Operation Sindoor? You know, a lot of talk about that was happening. How do you feel about that?
In a way, the FPIs were moving away because of the strengthening of interest rate in US for last almost a year. This month onwards, I think April onwards, the FPIs have started investing in India in a big way. There is also a talk about moving away from dollar. And so there are emerging markets like India, which is not so emerging because we are now the fourth largest in the world. But effectively, lots and lots of foreign capital is going to pour into different markets which are trustworthy. Currently, a lot of inflows are being seen in Japanese assets for the time being, which is moving away from US. But some benefits are coming into India too. So that's how you see a positive sort of inflows by FPIs into India over last 1.5 months.
So from a sector perspective, defense has been doing very well post Operation Sindoor, and obviously the budget allocation that we saw in this year's budget. How do you see sectors panning out? Do you think there is some bubble, or do you think some sectors are going to come up?
In a way, whenever such what I call path-breaking situations happen, a lot of companies get involved, and naturally India has actually changed the paradigms of war which had come about over last 10 years, which was largely drone-driven. And the first time over last 10 years, a country has proven that over a border of 5,000 kilometers plus from Ladakh to Kutch, India has been able to protect itself from the low-cost drones, which is itself a unique achievement. And I think the new phase of the way the battles are fought are going to be basically fought on the way India is now defined, or India is redefined. And that's where many of the Indian companies which have provided this equipments to Indian armed forces would also have their equipments in demand across the world. Of course, within Indian armed forces also, but across the world. And that's where I think you might see some movements. But overall, we don't look at individual companies. What we see is some of these things happen because of the way the technologies change, the way the frameworks change, and clearly India has redefined the concept of battles and wars, over which was coming up over the last 10 years in some ways.
The last question from you is that there is a lot of talk today about the expiry day circular from SEBI. What is NSE's take on it? Is there a day that you have decided?
No, we have not been aware on, we are getting it from you, but whatever the decisions of SEBI, we will have to go by.
And sir, what about the IPO? Where has that point reached?
Again, we are awaiting our no objection certificate. We have applied to the regulator, and as and when that comes, we can do the further process of preparing the DRHP and later on filing it with the regulator again and things like that. So it's a still work in progress.
Thank you so much, sir, for joining us here on CNBC TV. Thanks a lot. Thank you.
Welcome back. Varun Rochab is still with us. Varun, thank you for staying on. You know, I can't not talk to you about defense, right? Because there is so much that has happened. Stocks are up 50-55% in the last month. And the broad gamut of the sector that it is, where do you position yourself in? Would you go in with the traditional names like the BELs and the HLs? Do you go with the shipbuilders? Or do you go with the equipment suppliers like Zen? Or even for the technology names like Data Patterns?
Fortunately, won't be able to comment much on that because we don't cover the defense stocks, So, but as a space, obviously in our capex report, we have been consistently highlighting in the last couple of years that the defense spending by the central government seems quite structural, the runway of growth is fairly large for these companies. And in addition, now even the export story should pick up for the sector. But beyond that, we don't cover individual stocks, so won't be able to comment.
But do you cover individual stocks within the pharma basket then? Because that is another sector that has been under a lot of uncertainty with regards to the tariffs that have coming in, the pricing pressures in the US markets. Again, the generic players, the CDMO players, where in pharma?
So pharma and healthcare both we cover, and in fact we like both of those spaces. We have been quite positive on names like Sun Pharma has been our top pick for the last 12 to 18 months. We also like Torrent Pharma, Eris Life Sciences among the smaller names, Alchem Labs. So these are some of the top picks from the pharma space. Even CDMO space looks quite attractive from medium to long term. The growth rates are looking attractive. Inquiries have increased, though I think FY26 numbers are not looking that great for some of the CDMO companies vis-a-vis the expectations, which were very elevated. But from a medium term, 2 to 3 year view, we are quite we see good opportunities in the CDMO space as well. So pharma and healthcare, I think overall is a good space to be in from a next couple of years perspective.
What about banks, Varun? I did ask you about IndusInd, but you mentioned that there are other names that where you could find value in. So would you like to go with the larger private banks, which have still been there and thereabouts in terms of giving returns, but it's not the 15, 20, 25% returns that you would find elsewhere? So private banks, PSU banks.
See, I think 20-25% return expectations would be a bit too much from a large sector like banking. What we are anticipating is that next year would be better for banking sector from two perspectives. From a smaller bank's perspective, the credit cost will normalize upward. Credit cost will be better for some of the smaller banks which saw a lot of pain in FY25. And at the same time, the large banks and overall banking sector will have some NIM pressures, which will lead to overall PAT growth of around 10 to 12% for our coverage universe of the bank. So, but valuations are supportive, so there is some room for PE re-rating. So to expect 12 to 15% return from banking stocks would be a more reasonable expectations. And we believe the larger banks are better positioned to capitalize on the growth as well as to be able to navigate the volatility and the pockets of stress in terms of the credit on the credit side. And the liability franchise, the cost of deposits, that has already some of the pain has already gone through in terms of the NIM compression. So incrementally, I think beyond FY26, that pain should also subside. So large banks, ICICI, SBI, have been our top picks for quite some time. And even Axis Bank we like. So I think these three would be the top picks in the banking sector. We are still sticking with the large banks.
All right, Varun, thank you so much for sparing time and joining us. Looking forward to having you more often on the platform. Take a short break. The management of TeamLease joins in on the other side. Stay tuned.
Welcome back. The next corporate conversation is with TeamLease Services. The stock right now is up by close to about 4% and perhaps reacting to the improving margin trend. In Q1 of FY25, margins were 0.9%. Q2, they expanded to 1.2%, stayed the same in Q3, and in Q4, they further expanded to 1.7%. And for the full year, revenue growth has stayed at 20%. Ramani Datti, CFO of the company, is now with us on the show. Ramani, hi, morning. This is Reema Tendulkar here. Before we get to the outlook, just explain the headcount decline. On a sequential basis, your overall headcount is down by 7,500. Is it purely on account of attrition in BFSI? Or are there any other pockets of weakness in hiring? And what is the outlook on headcount addition going forward?
Good morning, Reema. So specific to this quarter, as we have already called out in Q3, this is a planned absorption with one specific large NBFC. And other than this, we are not seeing any kind of challenge with other industries. In fact, all the consumer verticals for us are doing very well, both in terms of new headcount hiring and expansion to new geographies. So other industries, as of now, we are not seeing any challenge. BFSI is the only one that has impacted as far as general staffing is concerned. We'll come to IT later, but within general staffing for this quarter, the entire dip that we have seen is on account of the NBFC insourcing or absorption.
So is there a headcount addition guidance that you can share for next year?
So we would be comfortable to add at least 10,000 per quarter, so which is about 45,000 for the full year. That's the outlook that we have right now for next year. In case if BFSI and NBFC hiring gets picked up, it can be incremental to that number.
Got that. And how would this 45,000 crore of a headcount addition compare with what you did last year?
See, 2024, FY24, we did about 37,000 headcount. This year, because of the BFSI hit, it was down to 27,000. But going back to 45,000 looks achievable because we have already delivered similar numbers in FY24.
Sorry, you're saying FY25 headcount addition will be 45,000 versus 27,000 last year?
FY25 is 27,000.
Yeah, so you're expecting a big jump going forward.
Yes, that's correct. Because we are not foreseeing any further insourcings or absorptions in BFSI or any other vertical.
Sure.
And we are currently working on about 30,000 plus open positions. The demands are going up in other sectors and industries as well. So 40,000 volume addition for next year is something that we are targeting.
Got that. What about margins? Can you continue with the improving margin trend? And what would be the foremost reason which explains the improvement in margins?
Yeah. So one is, first of all, in all the businesses, we have already hit the bottom last year, especially in Q1. That's what we called out earlier as well. So we have been consistently improving on new client acquisition, more operational efficiency using technology enablement, and more focus towards cost optimization. That has definitely helped. In addition to that, we also have diversified our product portfolio, be it within our HR services or within specialized staffing, and also new geographies have helped us to expand the margins. And for next year as well, except for Q1, we will be able to demonstrate consistent margin expansion quarter on quarter. Q1, because of the annual appraisal impact, there'll be a dip in the margins. But barring that, we are confident of maintaining the margin expansion trajectory for next year as well.
Well, Ramani, you spoke about the BFSI segment, right? But what about others, like, say, the quick commerce segment or even the FMCG segment? What is the kind of growth that you have witnessed here? And what are the trends that you are currently witnessing on ground almost, 45 days into the first quarter?
Yes. So as I called out earlier, FMCG for us right now is giving the maximum open positions. In fact, out of the total open demands that we have right now, almost 35% are into consumer related verticals, be it FMCG, e-commerce, quick commerce, retail. These sectors are giving us the maximum open positions. In addition to that, pharma, telecom, and a few other emerging sectors are also giving us good open positions. BFSI at this stage is still lull. We are expecting some recovery around the festive season, before the festive season picks in. But at this stage, we are not having any major hiring demand as far as BFSI is concerned.
Now, we can't not ask you about IT, and I don't want time to run out before we get to IT hiring. I believe GCC, that's Global Captive Center, now contribute 60% to specialized hiring. Is that correct?
That's correct, Rima. So 60% of our revenue in specialized staffing comes from GCC. This number used to be 40% about a year back, and we have been consistently adding a good amount of clients on GCC front. So that's the good news. But unfortunately, on the IT services, the domestic demand is actually very low. And in fact, it has been slightly coming down quarter on quarter. And the uncertainty continues. Even at this stage, we are not seeing any green shoots as far as IT services is concerned, while we are confident on the GCC side.
% compares with 45% a year back?
Yes, that's correct.
Got it.
All right, Ramani, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of TeamLease, the street likes what Ramani was highlighting on the road ahead. Headcount addition seen at up to 45,000 compared to 27,000 in last year. The stock has now surged to the highest point of the day as the conversation went by. Take a short break. Up next, we put the spotlight on ITC. Numbers expected later in the day. Stay tuned. Welcome back. Nearing the lowest point of the day now for the index, 227 points lower so far, struggling to hold on to that 24,600 mark for the Nifty. So not very good going for the market so far, at least for the benchmark index. Of course, that does not take away from the fact that there are a lot of movers on the upside, and you pull up Fortis Healthcare. That is now the top gainer on the Nifty 500. That is also, of course, after the management commentary, which is on the bullish side in their earnings call, and you can see the move that you've seen in Fortis Healthcare, 9.5% higher on the stock. But the one that we're focusing on today is ITC. Numbers out later in the day. Mangalam is here with what the street is expecting. Mangalam.
Well, two things before we talk about what the street is expecting. For ITC, don't look at the versus numbers, because the current numbers will be X the hotel business, and the versus numbers, we'll watch it when it comes in, the income statement itself. So, which is why I've not given a percentage change in the numbers. So what you're supposed to look at is the numbers that the street is expecting, and this is adjusted for the hotel business. You're looking at revenues of 16,820 crores. The same number last year was 16,579 crores, but there is no percentage change we'll have to make, because the base will get restated once the company reports its numbers, ex its hotel business as well. So 16,820 is the important number to watch out for. EBITDA would be 6,100 crores and margins of 36.5% as well. And the net profit that you're looking at is 4,960 crores. The other part is that the most important number for ITC is the one that it does not give, which is the cigarette volume growth. The street is expecting 4 to 5% cigarette volume growth. This could be inferred with a 6 to 8% sort of gross revenue growth in the cigarette business, with a 3 to 5% EBIT growth. Any more than that would mean that there is a beat on the volumes. And then you'll keep an eye out on the FMCG business as well. 6 to 8% revenue growth is what the street is working with out there. But more than the revenue growth, I'll be curious to know how the margins perform, because last quarter there was a big dip in the margins. This time around, the street expects a 200 to 300 basis points dip there as well. And finally, the revenue growth on a low base will be led by the agri business because of favorable environment right now in terms of prices for tobacco leaf and the liberalized export policy. So agri business likely to show revenue growth of upwards of 20-25%. Paper business, 3 to 5% growth is expected, but that's because the cyclical nature of paper business, which is currently undergoing some sort of issues. So weak performance from paper business, good cigarette volume growth. The overall numbers come in ex-hotel demerger. Watch out for better performance in agri and margin dip in the FMCG vertical.
All right, Mangalam, thanks a lot for that. We'll keep an eye out on ITC, and just as Mangalam was mentioning, numbers not to be compared on a year-on-year basis, of course, because they'll be adjusted for the demerger of the hotels business. But with that, we call time on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.